Hi, everyone. Today's guest is David Garofalo, Chairman and CEO of Gold Royalty Corp. David, welcome to the channel.
Thanks for having me on, Michael.
Appreciate you coming on. Before we hop into this, which I'm very excited to get into the gold business, can you give us a little bit of a background, personal background in business?
Sure. Well, I've spent over 30 years, actually 32 years in the mining business now, mostly focused on developing and operating mines. Most recently, I was the CEO of Gold Corp, and I engineered the merger with Newmont to create the world's biggest gold company by market cap and production. And before that, I ran Hudbay Minerals on the base metal side and spent 12 years before that as CFO of Agnico Eagle during its formative years. So I have a long history on the mining side and developing and operating mines, but now I've positioned myself in a royalty company because I think we're in an inflationary cycle, and this is the best way to play gold in my view.
Let's hop into the price of gold. You mentioned inflation, and really since I think it's 2020, mid-August, gold has peaked out and it's been rather range bound. Up until recently, we're starting to see it break out a little bit, trading above 1900. It hasn't been there since mid last year. And it's coming not necessarily because of the inflation, at least it doesn't seem like it, but there are some geopolitical events taking place between Russia and Ukraine, and we're seeing gold move out on that. Now, my question is, being that inflation hit 40-year highs after 2021, gold really didn't do anything. And people are starting to speculate that that it may be not a great inflation hedge. Is that overblown?
I think it is. I think it's a very accurate barometer of what inflation is doing. And I would argue that gold held its value even as the purchasing power of our dollars have been basically destroyed over the last several years through expansionary monetary policy. Inflation today, a headline is at 7.5%, is actually far in excess of that. If you're putting food in your stomach, fuel in your car, or putting a roof over your head, it's not 7.5%. We're deeply into double-digit territory. And inflation's insidious. It eats your capital every day. It destroys value 15 to 20% per annum. That's my estimate of what real inflation is. If you leave your capital sitting in the bank account, effectively earning zero. And so gold has held its value in the face of that, and now is starting to accelerate in response to accelerating inflation. I think more importantly, in response to deteriorating real interest rates. So interest rates are deeply into negative territory on a real basis and falling even deeper into negative territory. So it really doesn't matter if Jerome Powell increases nominal interest rates a quarter point here or a quarter point there. When inflation has been unleashed and is continuing to accelerate, real interest rates will continue to deteriorate and gold will respond to that.
I'm assuming it's safe to say that you are bullish on gold, correct?
I am, and look, and I've been through a few cycles in my career. When I started in the gold business in the late 1990s, gold was $250 an ounce. And look, back then, real interest rates were deeply into positive territory. 7-8% was a typical yield on treasuries. Inflation was effectively zero. So, it did make a lot of sense to own gold because gold yields zero as a monetary instrument. Why would you own gold when you could own treasuries and get a real return on that? That's gone now. Now we're deeply into negative territory, and inflation's been unleashed really since the credit crisis back 12, 13 years ago, when central banks globally coordinated their efforts to expand money supply to stave off financial ruin in the economy. And they've really not stopped. It's been unrelenting expanding of money supply. And when central banks talk about tapering, it's a bit laughable because tapering doesn't mean they're actually contracting money supply. It means they're expanding money supply at a slightly slower clip. But money supply, make no mistake about it, is expanding. And what's driving that is the fact that we've, across the world, governments have strapped on significant amounts of debt. There's no fiscally responsible way for them to tax their way out of the debt. So the only thing they can hope to do is debase their currency and debase the debt. In other words, inflate the debt away. And so you're not going to see central banks rock that boat. They're going to continue to expand money supply, keep interest rates on a real basis deeply into negative territory, which means they're debasing their currencies, debasing the debt. And the one currency you can't print is gold. That's the currency that's going to go up in value.
Do you have any price targets, whether it's short-term or long-term, for the price of gold?
Yeah, for sure. Look, I think in this cycle, we're going to see at least $3,000 an ounce gold. And I think what's going to drive that is this deepening credit crisis, deepening negative interest rates that will drive capital into gold. And you don't need to look very far back in history to see it. Back in the late 1970s, when we last had this type of inflationary cycle, last had double-digit inflation. We saw, Paul Volcker, who came in at the Federal Reserve, start to increase interest rates in the late 1970s, but gold continued to gallop up. And that was because inflation was continuing to accelerate even as he was tightening interest rates. And it took a better part of a decade for him to bring inflation back into check. And so gold will continue to go up even as nominal rates will go up. So back then, gold achieved a peak of $850 an ounce. If you inflation adjust that to $2022, that's $3,000 an ounce. There's no reason why we wouldn't see that type of new peak in gold like we saw in the last inflationary cycle.
Now, when I look at the current price of gold, and maybe it can go to the target of 3,000, which I'm in that camp as well. If I'm talking to a new market participant that's so used to crypto gains, seeing them go 1,000% gains, they're going to look for, okay, but where's the leverage going to be? And that could really come into mining, right? In 2020, during the pandemic, we saw some miners hit 300+% off those bottoms. And it gets a little bit more complex in this sector. From my understanding, there's three subsectors. There's the explorations, which are looking for discoveries. You have the development, and then you have the producers. And do you want to talk a little bit about the risks involved with these mining companies?
No, it's an excellent question, because if you believe in gold as an asset class, the question you have to ask yourself is how best to play it to get optimum leverage to a rising gold price. And the easiest way, of course, and the lowest risk way is to buy physical gold. And I'd say everybody should have some of their portfolio in physical gold. I do, and whether it's in coins or bars or whatever. And that's a great way to play it because you don't have to worry about operational risk or political risk. It's a highly liquid commodity that can readily be bought and sold. But of course, it doesn't grow in size. It will go up if the gold price goes up, the value of it. But you have to pay for storage costs. You have to worry about security. And you could buy the ETF and see some economies of scale in the storage costs. And there's a GLD on the New York Stock Exchange physically back. So there is a way to play physical gold. And that's opened up a universe of investors that couldn't buy gold before, like pension funds and mutual funds, having an ETF physically backed by gold. And that's great for the commodity, and it's great for the industry. But again, it doesn't grow, and it erodes a little bit in value every year because of those storage costs and security costs. The other way, of course, is buy the producers. And, in a stable cost environment, if gold goes up 50%, their profitability could go up 100, 200, 300%. That's leverage. But we're not in a stable cost environment. Of course, we're facing inflation in the general economy, and mining companies are not immune to that. And the other added dynamic in the industry is there's been a severe amount of underinvestment in new mine capacity. That's why reserves are down 40% from their peak. So the industry is going to have to reinvest back in the ground, back in exploration, back in mine development, and that will only amplify cost pressures, in my view. So the producers are likely to underperform the commodity, in my view, just because of those inflationary pressures. And you just have to look at what happened 10 years ago coming out of the credit crisis as evidence of that. Gold went up 140% coming out of the credit crisis. The producers actually only went up about 66% because they had significant cost pressures, because we were in the middle of the Chinese super cycle. Base metal companies were building new mines, precious metal companies were building new mines, and that was driving up labor costs, input costs generally. And now we have the backdrop of inflation in the general economy that will only amplify that, as I said. So I think that the producers are actually positioned, they'll do well, but they won't do as well as the commodity, in my view. In that previous cycle, 10 years ago, the streaming and royalty companies went up 350% against 140% increase in the gold price. So they did provide that 2 to 3 times leverage that you're looking for in a rising gold price environment, because they get a percentage of the top line. They get exposure to the exploration upside because the royalty applies not only to the existing reserves, but any growth in those reserves. But they're completely insulated from operating and capital cost inflation.
Can you tell us maybe shortly what a royalty company does, what it is?
No, it's an excellent question. Effectively, it's a bank. That's the best way to look at it. And it's a single purpose bank. It's focused singularly on the precious metal business. And what we do is we provide capital to the explorers, the developers, even the operators who are looking to grow their production base by building new mines, exploring for new ones, or expanding existing ones. And we provide a much more cost-effective source of capital than them, say, raising equity in the capital markets. And we take a royalty back in return, but it's a perpetual royalty. And it not only applies to the existing reserves, but any growth in the reserve profile. So we provide optionality to that exploration success. And again, we take a fixed percentage of the revenue, typically half, 1%, 2%, 3%. It varies depending on the property. And we get a percentage of that top line. So we get optimum leverage to the gold price. We get leverage to the exploration success. But because we're not tied into the profitability, it doesn't really matter what the cost structure is at the mine. It can inflate because we're only getting a percentage of the top line. So we're completely insulating our shareholders from that risk. And the other element of our business that really I think is quite attractive is the diversity of our portfolio. We have 191 royalties at Gold Royalty Corp. That's a lot of diversification in our portfolio. If something goes wrong at any one of those royalties, it's not really going to move the needle for us negatively. Whereas if you're an operating company, even the most senior ones rarely have more than a dozen, 15 mines in their portfolio. Any one of those assets, if something goes wrong, it really does move the needle. It does expose their shareholders to significant risk. So we provide diversification because the nature of our business is such that we can run our business with 6 employees. Every dollar of incremental revenue we have goes right to the bottom line. And those 6 employees can manage a very broad array of royalties because, again, at the end of the day, we're just managing contracts. We're not actually managing mines.
Can you tell us a little bit more about Gold Royalty Corp? How long you guys been around? Potentially, I don't know if you can disclose this information, but if there is any public information about it, any particular shareholders that are invested in Gold Royalty Corp as well?
No, for sure. Well, we were created just 11 months ago in an IPO in March of 2021, spun out from our former parent company, Gold Mining Inc., initially with a royalty portfolio of 14 royalties written on their dozen development stage assets, which collectively had about 32 million ounces of gold resource on them. These are 43-101 resources under Canadian reserve rules. And so that's a significant mineral endowment. And we were able to raise $90 million US on the NYSE during our IPO and achieved a $200 million post-money valuation. And then we recognized that it was a highly fragmented universe in the royalty space. There were a lot of smaller cap players with really a liquid trading. And we were looking for an avenue to grow quickly. And we actually absorbed 3 of our peer companies, Ely Gold, Golden Valley, and Abitibi. And we grew that initial 14 asset royalty portfolio to 191 royalties as a result of our M&A activity. And now we have 6 cash flowing royalties. We have 11 in construction. And then we have this broad array of diversified royalties from early stage exploration right through to feasibility. So we have a lot of organic and embedded growth within the portfolio. And as a result, our cash flow profile is growing by a compounded average growth rate of over 60% over the next 3 years. So we've established a solid foundation of cash flowing assets with significant growth embedded in our portfolio. And that gave us the confidence 10 months after our IPO to initiate a dividend of just under 1% yield. We're paying a quarterly dividend of a penny per share, and that equates to just under 1%. And we have a high degree of confidence, given this growth trajectory that we have in our revenue, that we should be able to grow our dividend over time as well.
Has there been any significant accomplishments this year with Gold Royalty Corp?
Well, I would say the dividend was a significant accomplishment. The fact that we've absorbed 3 of our peer companies, successfully integrated them into our portfolio, established this growth trajectory that we have, and actually most recently just launched a bid for another competing company, Elemental Royalties, which would add another 9 royalties into the portfolio and add Australia into the portfolio. Right now, all of our 191 royalties are exclusively in the Americas. And 75% of that existing portfolio is in the 2 best mining jurisdictions in the world, Quebec and Nevada, by value. And those are the best jurisdictions as judged by the Fraser Institute for high mineral potential, low political risk, and low regulatory risk. So Australia would bring another tier one jurisdiction of the portfolio through the acquisition of Elemental, which would complement our portfolio in North America and South America.
Now, from my understanding, Gold Royalty Corp, it's not the only gold royalty company out there. So I want to know how does investors see more value with Gold Royalty Corp versus potentially another royalty-based company?
Well, look, it's a fairly simple landscape. There are three large cap companies in the space. That's it. And that's Franco-Nevada, Wheaton Precious Metals, and Royal Gold. After that, there's a proliferation of small cap royalty companies that have come into the sector over the last several years, none of which have undertaken the difficult work of actually consolidating to create a relevant mid-tier company where none exists. There is no mid-tier company in the royalty space. And what we're endeavoring to do through our consolidation efforts is, one, cut out significant G&A, because a lot of these liquid companies are frankly just hobbies for management. They don't really create value for their shareholders. By creating scale, we believe we can close the valuation gap that exists between these small cap companies and the large cap companies in the space and become much more competitive for new royalty opportunities out there. So we're trying to create scale very quickly, and in doing so, trying to create a re-rate for our shareholders. And we've been largely successful in that, in creating scale very, very quickly and really percolating to the top of the smaller cap companies in the space.
Are there any analysts covering Gold Royalty Corp at this moment?
Yeah, there are three currently, BMO, Bank of Montreal, Haywood, and H.C. Wainwright. And in the case of H.C. Wainwright and Haywood, we are their top royalty pick for 2022.
Awesome. I've looked into many different exploration companies, and I just wanted to ask this question. How difficult is it to find new gold deposits?
Well, it's not only difficult geologically, but it's also difficult to bring them into production. Typically, the lead time from discovery to first production is 15 to 20 years. Just because it's geologically complex to define these deposits, it's complex from an engineering standpoint to make an economic case for them. It's complex from a regulatory standpoint to get the permits. It's complex from a social standpoint to get buy-in from the surrounding communities. So you can imagine with these kind of multilateral negotiations going on, multilateral stakeholder engagement that's required to bring these on, how complex it is to bring new deposits on. Plus, they're very capital intensive. The barriers to entry from a financial standpoint are extremely high. So not everybody can build a mine. It requires a strong balance sheet, a deep technical team, and that kind of multilateral stakeholder engagement, which really, really can take many, many years to do. That's why as an industry, we've seen reserves decline 40% from their peak in 2012. There hasn't been that reinvestment back in exploration and mine development required to replace what's a depleting reserve base in the industry at large.
David, I want to thank you for coming on. First and foremost, if there's anything else that you want to add about this industry for our listeners to hear, please do so. If not, if you can just let us know where listeners can find out more information about Gold Royalty Corp and also about yourself too.
No, for sure. I mean, our website is goldroyalty.com, so very easy to remember. We trade under the symbol GROY, GROY on the New York Stock Exchange American, and we'd be delighted to take any of your calls on our 1-800 number, or if you want to send emails on our general email delivery box. I quite often respond to those myself, so be delighted to hear from you.
Thank you so much for coming in. Appreciate it.
Thank you.